Good morning. My name is John Snow. I'm the General Sales Manager at Lifto Limited, and I'm here today to speak to you at our second webinar in a series we're calling Elevating Minds. And today, our guest is Chris Somos. Chris Somos is the National Sales Manager for Toyota Commercial Finance, our partner in financing material handling equipment. Chris is here today to speak to us about a variety of products and services that Toyota Commercial is offering, and to help you make a decision, a best sound decision when procuring a piece of material handling equipment. At the end of the webinar, there will be an opportunity for questions, and without further ado, I'd like to welcome Chris. Chris, welcome.
Thanks, John. Appreciate you having us here for the webinar series, and thank you to all our listeners tuning in today. I'll just flip to my presentation. So as John mentioned, I'm here today to tell you a little bit about Toyota Commercial Finance, as well as to review some basic finance concepts that should help you when making financing decisions and acquiring equipment for your business. So Toyota Commercial Finance is Toyota Industry Corporation's financial services company, and our mission is to support the end users, customers of Toyota Industries Corporation businesses, such as Toyota Material Handling, to acquire and use that equipment, as well as to provide financial services to Toyota's business partners, such as dealers and other entities within the Toyota enterprise. And we've been doing that in different forms since 2003. Our business is based in Toronto, but we do have regional offices in Kelowna and in Lachine to cover all of the nation's geography, as well as the official languages. As I mentioned, we exclusively do business with Toyota Industries Corporation customers and business partners. And so we only work with brands such as Toyota Material Handling, commercial trucks, and Vanderlane and Bastion Solutions warehouse automation products. So why do businesses finance? And this information isn't specific to Toyota Commercial Finance. This is true of any lending, whether it's with us and for material handling or for other equipment in your business. And basically, businesses finance primarily for the benefits in cash flow. They're trying to match the cost of a given piece of equipment or an asset to the benefit that it provides over its economic life. So if you're planning to use, let's say, a forklift over the course of 5 years, instead of having all the cash outflow when you acquire the equipment, you can spread out those cash outflows over the 5 years that you plan to use that equipment and make money and expect cash inflows from that benefit. Businesses also finance so that they can benefit from equipment sooner. So instead of accumulating capital and then purchasing equipment once you have all of the cash in the bank, financing allows you to get the equipment right away, and then hopefully that new equipment will bring you benefits in increased productivity or lower operation costs. And then with that incremental revenue, you can pay for that equipment, lowering the effective cost of acquiring that equipment. Financing can also have numerous tax and financial reporting benefits. And for that, we always advise you to speak to your accounting professional, as they are in the best position to give you that advice. But very broadly, different financial products can help manage the timing of the expected tax benefits, and we'll talk about that a little bit later in the presentation. And different financial products also affect how those products are accounted for in your financial statements, and we'll talk about that a little bit too. Financing helps companies establish commercial credit, and this is particularly important, for businesses that are new in the marketplace or growing, as well as businesses that have suffered some financial challenges in the past. Many commercial lenders report to the major credit bureaus. We're talking about Equifax, DNB, PayNet, and the like. And having those consistent payments is a very strong way of building your commercial credit profile, and that helps your business in terms of its reputation, as well as lowering its future borrowing costs. Financing also makes budgeting easier. As I mentioned, you're sort of spreading out cash outflows in a predictable way over time. And that makes it very easy for enterprises of all sizes, from small businesses all the way up to public companies, to manage their cash flow, knowing that instead of having irregular large cash outflows as they have to buy of new equipment and dispose of it, they know that for a given piece of material handling equipment or any equipment, they'll have a certain predictable cash outflow, and that makes the whole budgeting process easier. Services can also be bundled with financing to enjoy the same sort of budgeting benefits as well as cash flow benefits. So in the context of material handling, what that means is things that would help enhance the productivity of your forklift, such as extra warranties, service, and maintenance, as well as training, can all be bundled with that equipment, so that all of those benefits can be termed out and have a predictable cost over the life of that equipment. That's easy to budget for and easy to afford. Financing with commercial lenders helps protect liquidity, and this is something that I think is on everybody's mind right now with the COVID-19 economic contraction. We typically advise companies not to use their operating line at their bank in order to acquire expensive equipment, because your operating line is just for that. It's a very multi-purpose credit facility that you can use for different things in your business. And the last thing that you want when there's an event in the marketplace and you need liquidity is to have all of your operating line tied up, with the purchase of expensive capital equipment. So we always advise our customers, again, to use commercial lenders such as ourselves to finance equipment and leave the operating line for more general purpose needs. The cost of borrowing has been historically low since the 2008-2009 financial crisis and the corresponding contraction that has brought. So the cost of getting all of these benefits to your business is at an all-time low. So it just makes sense to leverage all of these benefits when the cost of doing so is so inexpensive. With leasing in particular, 100% financing is often possible. So as opposed to other forms of financing where they typically have to put some sort of cash down, you can get the equipment sooner and at an even lower cash cost by leveraging leasing, which allows you to get the equipment with minimal cash outflow up front. And then finally, financing with a commercial lender doesn't put pressure on your other financial services. Similar to the liquidity argument, usually your bank or other financial services companies only have a maximum exposure that they want to have with any given customer. And by financing with a commercial lender, when you want to leverage other services from your bank or other financial institution, such as increasing your operating line or acquiring insurance products or taking advantage of factoring or other things that banks are good at, you won't be capped because you have all of your equipment with a commercial lender such as Toyota Commercial Finance, so you can get the best of both worlds. So that's a little bit about why businesses finance and what the benefits it can bring to your business. Now I want to talk a little bit about where CF Canada fits in the picture. So what do we finance? As I mentioned, we're a captive financing company for Toyota's commercial and industrial equipment. So that means in this context, we can finance anything that is sold by an authorized Toyota material handling dealer, such as Lifto. That includes, of course, new and used Toyota material handling equipment, but that also includes new and used other brand equipment that's sold by an authorized Toyota dealer. Let's say loading docks, or might be a floor sweeping piece of equipment, or whatever the case may be. We can also finance loose batteries, chargers, attachments, and other peripheral equipment that it enhances the productivity of your Toyota material handling equipment. We can also, as I previously mentioned, bundle services and finance those with your equipment. So again, extended warranties, maintenance plans, as well as training are great ways to enhance the productivity of your forklift, and we finance those along with the asset. And basically anything that has a serial number and is sold by an authorized Toyota material handling dealer is something that we can look at. Now, today I want to talk to you about 3 of our 4 main financial products, and these are loans, capital leases, and operating leases. And these are, common products to most commercial lenders. So while I'll be talking, from the point of view of Toyota Commercial Finance, this is also generally applicable to other equipment financing as well. So loans and CSCs, you might also hear them called installment purchases. Those are traditional loan financing. Capital lease, or what we call a track lease, or you can also hear it referred to as a lease purchase, an open-ended lease, etc. And operating leases may also be referred to as fair market value, a closed-end lease, a true lease, or a walkaway. And so now we'll sort of go over what the basics are of each of those products and when they would be applicable in different equipment financing cases and when they'd be right for your business. So with loan financing, this is not a very popular product, especially for material handling finance in the Canadian marketplace, and we'll kind of explain why. So in this, it's similar to a purchase in that the end user owns the asset and the financing company will place a collateral charge on it. Taxes are generally due upfront as cash down. So that's one of the main points of contrast, let's say, between a lease purchase, which is similar. Here, typically, let's say if you were buying $100,000 of material handling equipment in the province of Ontario, you'd have to pay $13,000 cash down at least as a down payment to cover the taxes. No, those taxes can be financed for very strong credits, but typically it's normal practice to put that as cash down. So right there, that's not a very attractive option for many customers. The structure generally does not have a residual or a buyback at the end, so you cannot use that to lower the monthly payment. That's another reason why it's not very popular. The tax deduction is immediate because you're paying the tax up front. You can claim the tax credit right away. And this is situationally useful. Let's say if you're buying equipment at the end of the year and you want to get the tax benefits in the year in which the contract was signed immediately, all up front, this can be situationally useful, but again, that's very niche. Typically payments in arrears, and because you own the equipment, all the rights and responsibilities of ownership rest with the end user. This is also situationally useful if ownership is required to take advantage of certain tax credits. Our listeners tuning in today from Atlantic Canada might be familiar with the Atlantic Equipment Tax Credit. That's one case in which this is very popular, and it's necessary for the end user to own the equipment to take advantage of the tax credit. So that's one situation, again, where this is useful. Here, only interest is counted as an expense. Otherwise, the capital portion is capitalized on the assets and the debt on the balance sheet and depreciated as you would for tax and financial reporting purposes. Finance companies may also only offer a loan or CSC if the type of work that you're doing carries an elevated level of risk. So for example, if you're handling explosive material, or if you're corrosive chemicals, or if you're performing some sort of operation that might transfer vicarious liability to the leasing company or to the equipment vendor, the finance company may say, look, we'll only finance this for you on a loan so that you own the equipment and don't transfer any liability to us. So that's another situation where you might, this may be your only option. But in general, for all those reasons that we discussed, this is not a very popular product for equipment finance in Canada. Capital lease, I would say, in contrast, is our best-selling product and is almost always a great choice when you want to own the equipment. So it's similar to a lease, but a purchase financing, but it does differ in key ways. So here, because it's a lease, the finance company will own the asset and a lien is registered. Taxes are paid instead of upfront. On a lease, taxes are paid on the monthly payment. So your tax benefits would also be accrued on a monthly basis instead of all upfront. The buyback can be anywhere from $10 all the way up to an amount that makes sense, given the credit of the company and the equipment. The customer is obliged to buy or refinance the equipment at the end. So a capital lease is different from an operating lease in the sense that the customer is usually obliged or responsible for the equipment at the end. A tax deduction, as I mentioned, is periodic throughout the lease. Payments on leases are typically in advance, so at the beginning of the month. Most of the rights and responsibilities are transferred to the customer, similar to as if they owned it. And that's in that same vein, the customer would capitalize the asset and the debt on the balance sheet and depreciate it as you would for tax and financial reporting purposes. Similar to a loan, only the interest portion is counted as an expense on the income statement. So the bottom line, the culture of business in Canada is traditionally been to own equipment, although that is changing. But anytime that a business wants to own the equipment and manage it for themselves, a capital lease is a great option to do so. An operating lease is something that we're seeing more and more of these days. Traditionally, this was something that larger enterprises leveraged because of the credit requirement to do so. But now we're seeing more small and medium-sized businesses want to take advantage of those same benefits, which I'll explain to you now. So an operating lease typically only is for new equipment. Toyota Commercial Finance or the other lender, as the case would allow, would own the equipment and a lien is registered because it's in the hands of the customer. Taxes are paid on the monthly payment, similar to a lease purchase. Typically in an operating lease, there's no buyback option, or the option to purchase the equipment is at an unspecified fair market value. And the reason for that is there are many tests, according to IFRS, that would stipulate whether something can be classified as an operating lease for tax and financial reporting purposes. But one of those tests is whether there is a discount purchase option, which means that the customer has effectively built equity in the equipment. So by not having a buyback option at all, if your business is never interested in owning the equipment, that is the most clear way of establishing that this is an operating lease for reporting and tax purposes. If you may want the option, you can always go with a fair market value residual in the contract. And usually that is a good option as well, but it's less of a convincing option than having no purchase option at all. So just keep that in mind when you're structuring your contract. And your tax or financial professional can give you more advice on that when it comes to your business and all of the other factors that are required in that test. Typically in an operating lease, if you do decide to return the equipment, or if you're obliged to return the equipment, it has to come back in what we call rental ready condition. And that means that it has to be in good condition given the application, and that all the systems have to work, it has to move under its own power, and all the wear parts have to be at a certain amount of life. Typically, your material handling professional will fill in a site survey, which describes your application and the number of hours that you plan to use the forklift. And that forms part of your contract, because that's how a finance company will set the residual for an operating lease. So if you tell the finance company that you'll be moving boxes of feather pillows and you're actually smashing bricks with the equipment, there'll be a substantial renegotiation when that equipment comes back. So you always want to make sure that information is as accurate as possible. Like a car lease, there's a limit placed on the hours, on the number of hours used in the contract, and the application that you use it as well, because again, that's how residuals are set. Tax deductions are periodic throughout the lease. Payments are in advance, like a lease purchase, and typically operating leases are always 100% financing. That's why the credit requirements are a little bit more stringent, because you have to qualify always for 100% financing. No equity is built in the equipment. So one of the main reasons why businesses choose this is because it's counted as what is referred to as off-balance sheet financing. So the debts and the corresponding asset are not capitalized on the balance sheet. And for the purposes of financial reporting and respecting, especially financial covenants. So typically, when a business, gets an operating line, there'll be certain ratios, like a debt to equity ratio, for example, that your business will have to respect in order to stay in compliance with the bank's offer. And having off-balance sheet financing technically helps companies manage those ratios, especially when it comes to debt. So that's one of the main reasons why companies leverage this product. Another is that the entire lease payment is passed as an expense, both the interest and principal portion, through the balance sheet. And that helps with certain CapEx restrictions within certain enterprises, as well as has certain financial reporting advantages. So when is this product right for your business? So this is really for businesses that always want to have a predictable cost for their material handling equipment. They always want good, newer, in warranty equipment, and often these types of contracts are paired with a maintenance agreement and other services, although not necessarily always. So if you have an operating lease with maintenance, you pretty much know that you have new in warranty equipment that's being serviced by the authorized dealer, so you know you have a high level of uptime that's guaranteed in your business, and that's what customers usually want out of this product. So you might use a piece of equipment for 3-4 years, and then cycle it out, and you get another one, and your costs of having that piece of equipment in place and working at a high level is always predictable, and that is a benefit that cannot be understated for everybody, from small businesses to large enterprises. It's also suitable for businesses that use pretty standardized equipment. It's not suitable if your equipment is highly specialized or customized. It's suitable if your operation is very predictable and not hostile to the equipment. So if you're going to be using your forklift in a huge variety of conditions, this may not be the product for you. It's great for customers who want to regularly upgrade, as I mentioned, because you're constantly cycling to the newest and best. And bottom line, it's great if you want always in warranty, predictable cost with high levels of uptime. So now that we understand what sort of the three basic financial products that commercial lenders work with, I just want to give you some great tips on making a credit application before we wrap things up. And this is mostly geared towards small and medium-sized businesses. The process by which larger businesses seek credit is a little bit different, but still, this is a good basic foundation for everybody. So number one, you want to make sure you have the correct legal name of your business. If you don't, or if you're trying to seek credit under an operating name because you're not quite sure, usually this can at best result in delays, and at worst, in incorrect information. So it's always a good idea to make sure you have the correct legal name of your business available on the application. You'll want to double check if that business is an incorporated business or if it's registered, because sometimes that can get confused. And again, at worst, it'll result in, or at best, it'll result in delays, and at worst, it'll result in a poor credit application. You'll want to provide all the addresses associated with your business. And the reason for this, especially for small and medium-sized businesses, the incorporated address is sometimes different from where the operations are, which is different from where certain vendors might have their information registered. Let's say, be that at the home of the owner, or at the lawyer's office, or their accountant, or a PO box. And each vendor will be reporting their trade history to the credit bureaus under the address that they have been provided. So sometimes, even if you've been in business for 10 years, the address where your operations are is not where may not have any credit history, because all of the suppliers have been reporting to the owner's house or to the accountant's place of business. So that's why you want to provide all the addresses associated with the business to make the strongest credit application possible. You'll also want to provide the contact information, name, title, phone number, email, etc. So that, because very often the financing rep will have to reach out to you to gather additional information. So you want to have that person be able to be contacted as quickly and efficiently as possible. You'll also, on a credit application, want to make sure that there's information for somebody who can speak to the financial aspect of the business. So in a small business, that might be the owner, it could be a senior manager, it could be the firm's accountant, or but somebody who could speak to the company's finances, and you'll want to have that person's contact information. You also want to let that person know to expect a call. So let's say when you're making an application for a new piece of material handling equipment, you'll want to have that, just give that person a heads up and say, hey, somebody from Toyota Commercial Finance is going to call you, because we've made an application for financing. Just so, because in this day and age, people are very concerned about phishing, and rightfully so. You'll want to have some trade references on hand. And typically those are suppliers that extend postpaid credit. And it's always best to give references for suppliers that have been working with you for at least a couple of years, so that they can really talk to a history with your company. If your company has had difficulties, and many companies are right now due to the COVID situation, you'll want to be upfront about those difficulties, whether that's a general challenge, or if you're having difficulties with one vendor, you'll want to just let the company know ahead of time. It just shows good character, and you'll likely get a better result on your credit application, than trying to gloss over it and then having the credit analyst find it later, because they always will. And if your business doesn't have a detailed website that talks about the operations of the business, just be prepared to answer some questions, because it's always necessary for a lender to have an understanding of what your business does in order to extend financing. And then just before I leave you off, there's a couple of things that are good to know. A lot of times when dealing with small and medium-sized businesses, some of these points come as a surprise, and it's always best to know this about commercial leasing. So generally, anything that is financed has to be insured, and that's true for leases and financing. The reason is because there's some liability that rests with your business, but also with the supplier of the equipment and the finance company. So as far as I'm aware, in Canada, there's no lender that will let you get away with not having that asset insured, because they can't quantify that risk. So if you're financing something, plan to have it insured. Commercial leases are generally non-cancelable. So it's common practice in the industry. Let's say if you finance something for 5 years, and after 2 years you want to buy it out, many commercial lenders will charge you the entire balance of payments to break that contract, and then you can sell it on privately. Toyota Commercial Finance is a little more flexible in that regard. Usually we'll just charge a nominal fee and let you trade up. So there's no cool down or return period. If you order the wrong equipment and finance it, generally your business is responsible for disposing of that equipment. It's not like a car where you can bring it back to the dealership and say, "Oh, I messed up and I need to bring this back." That's not available with a commercial lease or loan. And then finally, commercial leases are generally not transferable in the same way as you would, let's say, for a car lease. If you need to get rid of a forklift and you find your buddy's business wants to take it over, generally you will still be kept on as a covenant. Your obligation will not be removed. So just keep that in mind when you're leasing equipment. So we've covered a lot today, and I would want to thank you for reviewing this information with me. I know it's a bit of a dense presentation. So if you want to chat about this or have any detailed questions, or want to know more about what Toyota Commercial Finance can do for your business, you can contact Kathy Langdon, who is our regional sales manager, and she covers all of the English language regions for Lifto. And once again, I just want to thank you, as well as our hosts, Lifto, for putting on this fantastic webinar.
That was great, Chris. Thanks very much. A lot of great information you shared with us today. So thank you for that. We do have a few questions. If we could go through those with you, if you have a few minutes.
Yeah, I'd love to.
Perfect. So the first question is, does the client have to apply for new credit every time they purchase equipment? So I guess this would apply to an ongoing customer who is ordering either a new or used additional piece of equipment.
Yeah, that is a great question, John. And you know what, I'll tell you why this comes up a lot. That's because you don't want to make too many credit applications, because every time a lender looks at your credit bureau, it can potentially bring your credit score down, and that's not good because it increases your borrowing cost. So you really want to limit the number of times that you apply for equipment. Generally, with a commercial lender, once they pull your bureau, they will retain that information on file, let's say for 60, 90, maybe 120 days, and they'll consider that in that amount of time, your information will remain consistent. So if you're approved for a truck, let's say a forklift, uh, and then a month or two later you come back and you decide that you want another forklift, uh, usually they can reuse that same information. Or if you change your mind and need to reconfigure something, and you know better than anybody that it's not the same sales cycle as, let's say, getting approved for a car. Sometimes when you order equipment, it can vary, depending how much time you need to get that equipment.
True, very true. So good. I think you already touched on this in your tips slide, but how long does it take to get credit approval?
Right. So credit approval, that depends on how much existing credit you have and how much you're applying for. So typically, if an established business, it comes into a dealer like Lifto and says, I need one forklift, we can get that credit approved in maybe an hour or two, and have that approval back to the dealership very quickly. If you already have $2-3 million of equipment financed with us, and you come in to get another package of equipment, it'll take a little bit longer, because usually we have to contact somebody within your organization, update your credit profile, and that kind of goes back to what we were talking about in the previous question. Uh, uh, so often, what a commercial lender like us will do is set up a equipment line of credit to pre-approve a company that purchases equipment frequently for 12 months. And usually this involves getting financial statements, but then for the next 12 months, whenever you go to Lifto and get a new piece of equipment, you're already pre-approved, and you can basically just make the order without having to go through any approval process.
Good, good. I think one thing that's critical to that too, if I can just share, we can't order any equipment until we have credit approval. So if an order is placed with a sales rep, that is submitted to us, and then we pass it on for credit approval. We cannot submit an order to the factory until we have the green light from the financial arm. So
Yeah,
I think
that's a very
good.
important point, John, and I'm glad that you brought it up, because a lot of customers um, don't understand why we're very urgent when it comes to calling them, getting information, because they think once the order is signed at the dealership, then the forklift is already on the way. But that's not the case, as you mentioned. Usually, when the credit is approved, that's when they start building the forklift. So that's why in my earlier slide I touched upon all those tips to make sure that that we get in touch with you as quickly as possible and get the credit approval done, because only when there's a guarantee of payment from the finance company is when they start building the forklift.
So when that order is placed, I think it's important that if there's a different contact that we need to speak to when it comes to getting financial information or trade references, that you include that in the purchase order, or share that with the sales rep at the time of.
Yeah, exactly. Because the person who manages the fleet of forklifts is not always the same person, especially in medium and large businesses. It's not always the same person who is in touch with the company's finances. So, great point. You always want to make sure that you have, if you're not the person who can talk about the company's finances, make sure you put somebody on the application who can.
And give them a heads up that we're
Absolutely.
going to be contacting. Yeah. So great. Another question we have is if my business is experience any challenges related to COVID-19, will I still be able to qualify for financing?
I think that is a question that is on a lot of people's minds right now. And I think that this COVID-19 situation is much better, let's say, when we compare it to the 2008 financial crisis. there's much more access to liquidity in the marketplace, meaning that firms like ours are still lending money. And as I mentioned, if you're having challenges, that's when you really want to dialogue with your lender, and having a relationship with your lender is important, because we've been around the block many times, and we understand the difference between a event associated risk that has caused you financial difficulties and chronic problems with the business. So it's get on the phone with your lender, be upfront and honest with them, and I believe that in this current business climate, you will still be able to get financing. If you just have to make sure that you're provide a lot of information. If you're experiencing some challenges on what what that means, what the COVID situation means for your business, and that's also, again, where working with a captive manufactured leasing company is really has its benefits, because we are here to support the Toyota enterprise. We're here to support Toyota customers. That's our main mission, and we're committed to continuing to lend to support Toyota customers during the COVID situation.
Excellent. One last question. If a truck is on lease and the business needs change, whether they're expanding or their products are changing, and they need either a higher lift height or greater capacity, what's the flexibility on that? And I think that's a question for both of us, but I'll let you start off.
Yeah, so I can speak to the finance portion, because when you want to trade in your equipment, you're really, and that equipment is financed, you're dealing with two parties. You're dealing with the dealership, and you're dealing with the finance company who has the loan. So as I mentioned, most commercial lenders will charge you the entire balance of payments if you want to break your contract. But Toyota Commercial Finance is a little bit different. If you're trading up to get to exchange the equipment at an authorized Toyota dealer for a new piece of equipment, we'll actually just waive all the interest, and there's no fees associated. You just pay the capital balance, and away you go. And then what happens next is really in the hands of the dealer.
Yes.
So maybe I'll let you touch on that, John.
Yeah, and I would say that we're very flexible, and we're very open to supporting whatever those requirements are. We would have to look at the existing piece of equipment to ensure that you haven't gone over on the hours, and would have to take all that into consideration. But absolutely, we're more than flexible to rotate trucks out and introduce new products if that's what the application demands. So, Chris, if we could, I know we're going to be sending out a follow-up email after this. There's some great programs that were introduced last week to help with people during this period. Did you want to touch on those programs that were shared with us last week?
Yeah, absolutely. If you can just flip the camera back over to me for a moment. So right now, Toyota Material Handling, in concert with Lifto and Toyota Commercial Finance, has two current promotions right now that I'd like to share with everybody just quickly before we sign off. And it's an either or. So as I mentioned, during the current COVID situation, a lot of businesses need help with their cash flow. So what we've come up with is a plan to make no payments until 2021. And the way that works, it's eligible for all Toyota Material Handling equipment. And let's say you sign a contract for 48 months, we will just tack on skip payments until January 2021. The program does guarantee a minimum of 4 skip payments. So let's say if you order now, but your equipment, or let's say if you order in September and your equipment arrives in January, we'll still give you up to 4 months of skips. And so you can learn more about the details online at the splash page that you see here, or you can contact your Toyota Material Handling professional to learn more about it. And then if that don't pay till 2021 isn't right for your business, there's also another promotion that you can take advantage of, which offers a 0% interest rate for up to 12 months. on all Toyota electric equipment. And if you wanted to finance it for longer than 12 months, you can also take advantage of a subsidized interest rate for longer periods, up to 60 months. And again, if you think that that is right for your business, you can learn more about it on Lifto's website here at the splash page that you're looking at, or you can contact your Toyota material handling professional and they'll tell you more about it. But these are both great promos to take advantage of right now.
Great. Well, Chris, I'd like to thank you very much for your time today. This concludes our webinar. I'd like to extend a thanks to our partners at Toyota Commercial Finance for all their support. And I'd like to send out a big thank you to our frontline staff, specifically our technicians and our tilt and load drivers, for supporting our clients during this challenging period in history. On behalf of Lifto, I wish all of you the best, and we look forward to seeing you all of you soon. Take care.
Thank you, John. It was a treat to be here, and I'd like to also thank the listeners. Have a good one.
Thanks very much. Take care.
Take care. Bye-bye.